is our digital ecosystem forum, innovation and investment. The two definitely go hand in hand. Some great guests with me now for this session. We have Tyler Craft, SVP, Head of VirtualBank and Fintech at First Horizon Bank. We also have Diego Represas, founder at Able AI, and Lulu Chang, investor at Canapi Ventures. Hello to all of you. Thank you so much for joining us here at Fintech Live New York. Hello. Loads to get through over the next 25 minutes or so. So all of these questions I will open up to all of you, and if you wish to jump in as and when, you are very, very welcome to, and then I'll get to any questions we have from our fantastic virtual audience. I'll try to weave those in as we go. Where I'll start though is, let's be honest, it's a difficult investment landscape at the moment. Do you think in the fintech world we should be worried, or is there room for some cautious optimism?
I definitely think,
everybody at once there.
It seems like the me question. Great to be here, guys, especially with Diego and Tyler, who are both wonderful partners of ours at Canapi. Obviously, venture as a whole is going through some troubling times. There was a term sheet newsletter this morning that went out that really showed the decline in just venture deals and venture funding. But, as ever, venture is very cyclical, and I think that there's so much opportunity within tech in particular to continue innovating, and that's really core to our mission at Canapi, is to find great fintechs like Able that Diego has started to partner with great banks like First Horizon, that Tyler leads innovation for, and find real opportunities to bring the financial services system even further forward into the future. I think that any seeming lack of activity in the market is really an opportunity to think more carefully about the types of innovative solutions that we really ought to be looking for and investing in and creating. So if anything, I think it's a time to be really excited about where the market can go.
Well, before I go to the others on the panel on this, I'll just jump on something you said there, Lulu. For you and the guys at Canapi, where do you feel we are in that cycle? As you say, it is very much cyclical.
I think it would be foolish for anybody to suggest that we're at the top of the cycle right now. But the thing about cycles is that when you're in them, it's so easy to make an assumption about where you are, right? But it's always hard to tell. We are certainly nowhere near the peak of fintech frothiness that we saw in 2020 and 2021. But it's also hard to say how close to the proverbial bottom we are. So we're not necessarily in the business of determining where in cycles we are. We just have to deal with the hand of cards that we're dealt and make the most out of them.
Okay, Tyler, Diego, I'll go back to the first question for you. Is there room for cautious optimism, do you feel?
Diego, why don't you jump on it? You're a founder. You're a founder. You'd be optimistic.
Yeah, I think, I like to think of systems as a whole, and I think these cycles are just part of a healthy economy and a healthy ecosystem. And whenever the cycle takes a downturn, it has negative repercussions for individuals or individual organizations, but it has actually positive repercussions for the system as a whole, just because it kind of heals and grows from it. So I think that as a founder, there's lots of reasons to be optimistic, because the fundamentals of the broken systems and the areas of opportunity and the market opportunities remain, and somebody is going to have to take care of those problems. So I remain relatively optimistic. Certainly, investment criteria are going to change, but there are still problems to be solved, and founders and great companies, great leaders to take them.
Tyler.
Yeah, and just kind of building on, my two friends here, Lulu and Diego, and coming at it from the old school traditional bank point of view and innovating in that environment and being a partner in investments in that environment. At the end of the day, I go back to the thesis that got me interested in this space years ago, which is traditional banking has a lot of needs to make the lives of our customers better, to make their businesses operate better, to make our banks run more efficiently, smoother, faster, smarter. That has not changed. That thesis is the same. we've made a lot of progress actually in the last few years with partnering with companies like Able, with partnering with other Canapi companies, with partnering with people across the fintech ecosystem. And there's still many opportunities, and that's true for basically all banks, I think it's safe to say. And so that fundamental thesis survives beyond the ebbs and flows of interest rate cycles and valuation cycles and anything else going on in the broader economy. The underlying customer need and demand is there, and so you have to figure out ways to partner creatively and think about pricing, think about valuation, and think about all those things, and still remain focused on solving that underlying customer need.
Now, one question I would like to ask is, okay, this is a valuable bit of information, I would say. For you, what is the key of remaining successful in this current fundraising climate, though? Well, Tyler, I'll start with you on this one. I'll give you the first word.
Yeah, I guess I'm not raising funds since we're a bank. I'm not trying to raise funds in the environment, but I talk to a lot of people who are. And I think the differentiation is having a product market fit that makes sense for the long haul. Obviously, there are realities in valuation in terms of multiples and things like that right now as those facts change, and Lulu and Diego can certainly speak in that with more educated information than I have. But the fundamentals of having customers that are raving fans, that is the basic thing that I would look for to be an investment partner with a fintech, and I even think is a good sign when someone's wanting to be a vendor or have to be a partner of ours.
Lily.
Yeah, given Canapi's model, which is that our RLP base comprises around 70 banks in the U.S., so I completely agree with Tyler that it is obviously tantamount to us that there is a clear pull from the market. I think that now more so than ever, when we look at deals, what we're really looking for, rather than growth at all costs, and I'm sure that everybody listening in has heard this now many, many times, but people are really looking for sustainable growth and a legitimate path to profitability. I think the other thing that matters now more than ever is having a really backable, responsible adult team, right? I think that we are well beyond the years of having 18-year-olds who are, used to being able to raise hundreds of millions of dollars on billions of dollars of valuations. So we're looking for experienced operators who know how to take a company from A to B to C and know how to do so in a sustainable way.
Diego, your perspective on that?
I think my perspective on this would be relatively constructive to the previous two. The fundamental thing is that the rules of the game have changed in a certain way. And so I think the fundamentals of a business, great product market fit, sustainable economics, important market need remain the same. But the investment box, the investment criteria of the folks that are involved in venture, who are the ones that arguably are the worst affected by any downturn, have changed. So my suggestion always to founders is you have to understand how those investment criteria have changed and how your business was getting underwritten in the past and how it's going to be underwritten now, and understand really the specifics of it. I still talk to founders who, when I ask them, hey, like, what would your business be valued at today? They don't actually have a clear answer to that. And that to me would be quite scary, because what I would be trying to do as a founder is actually walking with various investors and being like, look, like, here's the economics, here's where we're at. What would be the current valuation? And, what would need to change in this P&L? What would need to change in order for that kind of like for a deal to make sense or to be better, or et cetera. So just understanding how the investment criteria match to business outcomes is important.
Because what is fascinating about this particular panel that we've put together for you today is you've got different perspectives on the same issue, which makes this fascinating. And the next issue we'll move on to is very much from the banking side of things. So Tyler, I will come first to you again. For you, and I guess it's a fairly obvious question, how important is it to foster a positive relationship as a founder with the bank and the VC investors?
Well, I think if you're a founder who wants to sell into banks, then it's sort of foundational to your business. Diego's a great example. I talk to Diego all the time and really value his insights. I think he's someone, when you build those partnerships, and people like Diego, is someone that can challenge the way we think as a bank internally. So we're learning lessons all the time from these partnerships. And I think banks should not underrate that. They should not underrate the reality of the learnings you get from hearing from people thinking about a problem differently than you maybe traditionally have. And at the same time, I hope that our value add back to those founders is to present the real problems that their real customers will have. So obviously, with anytime you go to a vendor, you're saying, please solve this problem for me. But when you partner in a ventures setting and really build these deep relationships with founders, with especially at early stage companies, you can sit down and talk about the nuances of the problem that are true for your experience at your institution, and work through solutions together that are going to scale up and apply to other banks and mean a real disruptive product, but they really are tailored for your needs. And so that's good for everybody at the end of the day.
Diego, well, let's flip it from your perspective and the perspective of other founders I'm sure you speak to. How important are those relationships?
So I would say, like, you know, there's two stakeholders here for us. There's kind of our customers, there's our investors, right? So talking about investors, I'd like to say that your relationship with the investors doesn't matter until it does. So in boom times, when everything is going great, like you don't really need to put that much work into it. But whenever there is a rough patch, that's when they really come to shine. And when your selection of your partner, as well as the investment that you put into it, into being transparent and fostering trust, actually matters the most. And I think right now, a lot of founders are observing that. Personally, I feel very lucky to have Canapi on our side, and they have been great partners throughout. I would say with your customers, this generally applies to any founder that has customers, but I think when your customers are banks, which tend to be more risk-averse, long-standing institutions with relationship-driven models, you probably want to be somebody who is thinking long-term and is willing to do the things that are required to foster a long-term healthy relationship of success over optimizing for the short term or some things that may be transactional in the interim. And generally, I would say that's something that you always want to do as a business founder. It's just a lot less, the bank ecosystem is a lot less forgiving due to the nature of the customer forgiving.
Absolutely. Lulu, I wanted to loop back on something you started to touch on a moment ago about the types of businesses and the types of fintechs that are being produced now. Do you feel with the current market as it is, do you think it's going to produce a generation of leaner, more focused fintechs?
Leaner and more focused, certainly. But I also think that we could really be seeing a new wave of really generational companies because we are facing such particular challenges today. Obviously, you know, the financial ecosystem over the course of the last 2 months has really been upended. And that leaves a lot of room for really creative founders to create really exciting new solutions. And so that's what we're really excited about at Canapi is the idea that, you know, in times of what feels like great trial and tribulation, can actually really be an opportunity for really quite awesome change.
Diego, what would be your take on that? I'm sure you're seeing all kinds of new things, so many founders with so many great ideas. How do you sit on that?
Yeah, there's a great phrase that says the hammer breaks glass but forges steel. So right now we just get to see which ones what turns out to be steel and what turns out to be glass. You know, I think these hard times at any point of time are constructive. They're constructive to the entire ecosystem, which is anti-fragile in nature. But, you know, they're destructive to the individuals that may be affected in there. So I concur that it's going to be net value add to the ecosystem as a whole.
Because Tyler, you're seeing this from a slightly different perspective. You see it maybe a little more from the outside in. Would you agree with that? We're seeing a different sort of generation of fintechs coming through.
It's certainly an evolving group, and I am fortunate that in my role I get to talk to a lot of founders and interact with them, whether it's in terms of partnerships with Canapi and other funds that we're connected to, or folks that want to work with the bank in all kinds of aspects. And in the last couple of years, I think Lulu kind of hit on this earlier, you're seeing a more mature model coming to market. You're seeing really well-defined product market fit. earlier in the conversation because you've got folks that have been through that cycle already. Many of these individuals now are second or third time founders in this cycle that we're experiencing, and they've learned a lot of lessons. They've learned what worked really well. Some of them have learned what doesn't work sometimes, and they're coming back to market and in a much more mature way. They're coming to a challenging market right now at the same time. Let's not ignore that reality. And at the same time, they're bringing that maturity and wisdom with them and really thinking about customer problems and really articulating how their product can help solve problems, which I know I said earlier, but I go back to is at the fundamental level, what we're trying to do here.
We're just going back to some of the questions that are coming in from the audience. I'll start with Michael's here, and it does return to what I was saying earlier about the position we are in the cycle. And you know what? If each of you can answer this question accurately, then we'll have done very well today. I think we will have broken some ground. The question is, when can you see the next bout of mass investment taking place? Is the downturn short or long term? So if you could all get out your crystal balls, I'd be very, very grateful.
I can start. No. Oh no, go for it, Diego. No,
I didn't think anyone would want to answer that one. You all want to. Lulu, should we start with you? Ladies first.
No, there is no hot take. The simple fact of the matter is that we don't have a crystal ball, right? So my answer is very much going to be a non-answer. I think it becomes very dangerous, really, for us to try to predict when there will be a bounce back. Look, at some point, companies are going to have to run out of money, unfortunately. And that will mean that venture capitalists will need to figure out which companies they want to continue to back and which ones they don't. That could be in 6 months, that could be in 9 months, that could be in 18 months. But I do think that there's probably going to be a spate of these things happening all at once. It would surprise me if it were a slow trickle. It does feel as though, you know, we say often that VC sometimes can be lemming-esque, right? So when one fund decides to really go in and make a change and say, hey, we're opening the floodgates because we're seeing a lot of these companies running out of money or needing, you know, looking for favorable terms, then that'll really unleash a new wave.
And Diego, working in that space with a lot of founders, what's the word on the street really? Are people finding it easy to access that investment at the moment, or is it a tough sell?
I mean, certainly it's a tough sell right now because everybody's coming off the sugar high of 1 or 2 years ago, right? Even if you are a game-changing company with the best metrics that you have, chances are that you're under very different expectations than you were before. I have a contrarian opinion though to this, right, and to this bounce back, which is I hope there actually isn't a bounce back. I hope that what actually happens is that we return to the 2012 to like 2017 areas of like valuations and steady investments, because that was like a time period when the venture model was working successfully and there was an appropriate amount of capital being poured into the system, right? I think if you do go and see this enormous bounce back, it's probably just symptomatic of an excess amount of capital being spent in a growth category that, quite frankly, grows but may not have the space to have so much capital in it efficiently.
Tyler, do you have a crystal ball? I do hope so.
No, I've misplaced mine today. I'm sorry.
That always happens.
But I will echo my two colleagues on the panel here and just say, you know, I think that we will see some return to some prior trajectory, right? Down cycles are not the end of the road, and the peak is not the end of the road either. And to Diego's point, I think finding a place that is a smooth, long-term, sustainable, consistent, repeatable, predictable cycle model of valuation and funding is the place that we hope to end up at the end of the day, and that just sort of stabilizes what it looks like to have a venture market in the fintech space. And so I'm optimistic that in a more normal environment, post-pandemics, post-interest rate cycles, that we can find a long-term normal thread there.
Yes, a normal environment, something we all can only dream of still, I'm afraid. But I'll start again with you, Tyler, on this one. For you, has working with fintechs helped, from your perspective, the large-scale banks to retain customers, or do you feel they're losing customers anyway?
I will maybe sidestep the directness of the question a little here and say banks that focus on customer needs and solving customer needs win customers. And I think actually that fintechs have been great partners in figuring that out. They've been great partners for First Horizon along the way. They've been great partners at other banks that I've seen that we look to as examples of how to build partnerships. Obviously, there are fintechs that we sort of consider non-bank friendly fintechs and think about competing with banks and sort of see banks as their natural enemy or something like that. And they bring a lot of lessons to banks. They force us to think about how we approach our clients and our target customers and provide financial services in our economy. And that's healthy for us to learn from that. And then there's this whole group of fintechs that want to be partners of ours and bring that same mentality as a partner to solving customer problems. And when you do that, we have seen success in retaining customers, in growing relationships, in building better products and services for our clients as well through those partnerships.
Yeah, I do love the way you keep returning to the importance of the customer and the customer relationship, even in a challenging ecosystem. But one other thing I wanted to move on to before I just get on to a couple more questions from the audience. For all of you, how important is it, the diversity in corporate culture within an organisation for today's VC and PE investors? Lulu, I'll start with you.
It's incredibly important. I think that having a diversity of opinions around the table that generally comes with having a diversity of backgrounds and cultural representations, that's what really makes for really exciting discussions in investment committee and even in the types of founders and companies that we bring forward, right? The types of folks who I would make meaningful connections with are likely not the same types of folks who some of my other colleagues who may not look like me bring. And that's not to say that it's better or worse, but it just does create a much more authentic and representative work environment, investing environment. And so I'm really encouraged by the fact that increasingly, as part of ESG initiatives and DEI initiatives, that there is a growing focus on bringing more diversity rather than looking to squash opinions that perhaps are not commensurate with the status quo.
Diego, is that something that you'd agree with from what you see in the marketplace at the moment?
Yeah, I would concur with that. I think that fundamentally anything any startup is trying to do, whether they're disruptors, so they're trying to save the system, is they're trying to find an edge. You're trying to seek alpha in one way or another by finding something that is non-obvious. And you can't get to a non-obvious answer if you have a homogeneous pool of thought, right? So I'd concur with Lulu on that.
And Tyler, from your perspective, it's such an important part of the discussion now. Is that the way you view it?
Absolutely. I mean, I have a personal sort of motto for myself. That I think the odds are pretty small that I woke up this morning understanding and being right about everything. And the more that we can bring in diverse thoughts, diverse experiences, diverse backgrounds, diverse perspectives, the better off we all are. If we've got a history of explicit and implicit biases that have not just hurt folks that were impacted directly by that, but it's hurt the entire ecosystem, the entire economy, by not including the best thought because of unrelated things, not whether or not it's the best thought, but whether or not there was some other bias at play. And removing those biases actively, I think, opens the door to the best ideas, the best developers, the best products coming to the surface. And I think everybody's better off at the end of the day in that reality.
And I'll go to one last question if I can. We've only just got a couple of moments before the next networking break. But in the difficult investment landscape that there is, we've talked a lot today about collaboration, about partnerships. Do you feel in that more challenging environment, it has made people work together better to come up with better solutions and, as you've said on several occasions, Tyler, come up with a better customer experience? Diego, I'll start with you.
I think you have to work better and you have to do those things to be determined if it happens for everybody. But I think what you mentioned is a necessity for success, right? More so now than ever.
Tyler?
Yeah, I'm glad that my message that the customer comes first is coming through loud and clear. They say you need to say something 8 times before people internalize it. So I think I've gotten pretty close to my number. And look, when you're in situations like this forges strong partnerships with folks who want to solve problems. It will help sort that out a little bit. And when you see people coming together and rolling up their sleeves from all different aspects of the partnership, that's encouraging, and I think you get really great outcomes in those times.
And Lulu, I'll give you the final word on this. Do you really see those partnerships are coming to the forefront now because, as we are in this difficult environment at the moment?
I think so. I don't know that this is unique to this environment. I think one of the great things about the venture ecosystem and fintech and working with banks is that it is very much an inherently collaborative environment. The truism is true that a rising tide raises all boats. And so, one of my favorite things about working in this industry is that you have to find great allies across the board, whether it's to bring together a really wonderful cap table for a company or to figure out, which banks make the most sense to introduce to your awesome founders, or which champions at the banks you're going to introduce to your portfolio companies. So collaboration will always be key. I am glad that it seems, at least, as though a difficult environment fosters more of that. But I don't think that is for a better. Actually, I don't think that is unique to this particular time.
Okay, well, that seems a good time for us to wrap things up on this panel. Thank you, Diego, Lulu, Tyler. Really enjoyed your company today, and thank you for joining us here at Fintech Live New York.
Thank you.
Thanks for having us.
Thank you.
Thank you very much indeed.